Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. Make sure you ring the notification bell to get notified each time a video comes out. I recently had an opportunity to create an introductory presentation about personal finance for 14 and 15-year-olds, and I presented it to the teens in the neighborhood and one whose dad is in my Edmonton Investing Mastermind group. The formula for financial independence and success that I presented is earn money, spend less than you earn, invest the rest, and don't get into debt. And I split the video along these lines. This is part 4, Introduction to Investing. A more detailed seminar will be put on in 1 to 2 years when the teens are a little bit older. The previous installments are in the links in the upper right. Investing. So investing is where we're trying to use our money to buy something that's going to go up in value and make money for us. This is how people get to financial independence, and this is how they have money in the end. So money makes money without you having to do anything, which is great. I get, and I'll talk about dividends. I'll get dividends. Stuff just drops into my account without me having to do anything. I don't have to wake up in the morning. I don't have to talk to renters or anything like that. So that's great. So that's basically money making money for you. My suggestion would be to start as early as possible. Don't let years go by. Some people don't like saving because they want to spend, but I kind of think of saving as delayed spending. The only thing is you'll have more to spend later. We talked about the compound interest. Time will do the heavy lifting for you if you start early. Now, in Alberta, age of majority is 18. That's when you can establish an investment account and start accumulating something called a tax-free savings account room, which I see somebody nodding, but we'll talk about that in that next seminar in a year or two. There's a workaround. There's an informal trust account, ITF, where a parent or a guardian can open an in-trust for account at a brokerage. The adult is the legal account holder and manages the investments, but the assets are held for the benefit of the child, meaning you guys. Once the child reaches the age of majority, the account can be transferred to them, but up until it's basically to their benefit. So if you can talk your parents into opening one of these ITF accounts, you can start earlier. The other thing is there's a concept of an emergency fund. Have some cash, 3 to 6 months worth of spending left aside. So if you need money, and maybe if your investments happen to go down, because depending on the investment, some of them do go down, make sure you have money to use in an emergency. So start early to allow compounding do its thing. So I'm going to show you 2 investors. Investor 1, interest rate is 10%. Each line is a year. So investor 1 started in year 1 and put in $1,000 in the 1 year. At the end of the year, they have 1,100 because they got 10% of that 1,000, which is 100, so they have 1,100. Next year, not only that the 1,100 is growing, but they added another 1,000. So now at the end of year 2, they have 2,310. Now, investor 1 doesn't do anything for the next 15 years. And at the end of the 20 years total, they have $28,000. Okay, they put in 5,000 at the beginning. At the end, they have 28,000. So 23,000 came from the investment. Now we'll compare to investor 2, who had a little bit of fun the first 5 years and didn't invest anything, and then started investing in year 6 and invested for the next 10 years, again, $1,000. At the end of the 20 full years, they will have around the same amount. They'll have around $28,000. The only thing is, only 18,000 came from the investment, and they had to put in twice as much as investor 1. So this is the power of compounding, where if you start early, so here's the red is investor 1. Investor 2 had to put in more money to catch up, and then they sort of for the last 5 years, they sort of run the same, 19,000, 21,000, they're roughly the same. I'll tell you guys, I started investing when I was 23. If you guys start investing at 18, you're going to be investor one while I was investor two. I still made it work because I put in a whole bunch of money because I unfortunately really disliked my job. I hope you guys find a job that you like, but your life can be a lot easier if you start early and you're investor one. This is sort of what I hope you guys can take away from this. Just to repeat that, investor one put in half as much as investor two. Investor two put in 10 grand. Investor one, just because they did it early, only had to put in 5. And for investor one, in the investments made 23,000, while only 18 for investor two. Nothing to sneeze at, nothing bad, but you can let time do the heavy lifting. Invest regularly. So let's use maybe a more realistic example. Let's say you put in 40 bucks per month, so 10 bucks a week for 5 years. Again, we're going to use 10% a year. So this is what you do. The interest rate is on a monthly basis. It's still 10%, but divided by 12 comes to 0.83. Here's, you're putting in your 40 each month. At the end, you will have put in 2,400 bucks and it's worth 3,100. So the investment didn't run really long enough for the compounding, for the curve to really start arcing upwards, but you still got more than 700 bucks for nothing. So that's sort of the idea. So about 23% of the total ended up coming from returns of the investment, and you only had to put in 3/4. The other thing is, as far as financial independence and what your net worth is, net worth, I should define, is your assets minus your loans. So assets minus liabilities, or what I own minus what I owe, is your net worth. The biggest determinant of your net worth is how much money are you putting in. If you make 11% instead of 10, that definitely makes a difference, especially over a long time. But for most people, the biggest thing is how much money are you putting in? How much are you earning minus how much are you spending? The other thing is, in order to invest regularly, I would suggest automating your investing, meaning you can set up where they pull the money out of your checking account automatically. So as long as there's money in your checking account, you don't have to press a button, you don't have to do anything. I think reaching my financial goals, I think, didn't come from finding a magical investment that did huge returns. All I did was I was reliable, disciplined, and diligent, and motivated. Again, not enjoying my job. Any spare money that I had went into it. That's not what I'm asking of you. I'm not expecting anybody to live their life that way, unless you choose to. The regular, early, and it's just like my personality. I can stick to diets. I can go running 3 times a week, even though I don't enjoy it. I can do stuff that I need to do. For me, investing was the same thing. You have to determine if it's something that you have to do as well. Delayed gratification is basically what investing and saving is. You don't spend some money today in order to be able to spend more money later. They do fun experiments in a lab on like 5-year-old kids where they say, here's a candy. I'm going to walk out of the room. If you don't eat that candy in the next 5 minutes, by the time I come back, I'm going to give you a second piece of candy. The 5-year-olds eat it, always. The older ones, they'll like, I'll take 2 candies if just wait for a little bit. So just that's the delayed gratification. As adults, we should be better at it. It turns out we're not. So yeah, investing is delayed spending. I mentioned that. So some ways of investing, like we're early on it. I just kind of want to throw it out there. You can buy stock. Stocks are shares of ownership in companies. So you can buy a tiny slice of Google, of Netflix, Walt Disney, Amazon. These are publicly traded companies. They have shares out, and these shares are tradable. Somebody has a price for a share. You say, okay, I'm going to pay your price, and you can own the share. If If the company does well by making more profit than it is making today, people are willing to pay more for that company and be owners. That bids up the price, and that makes your shares more valuable as well. So you benefit from that, and it increases their value, therefore the amount of assets that you have. This is called a capital gain. You're gaining in capital when Amazon goes up by 5% in a month. Some companies pay some of their profits to the shareholders, to the owners. So you get income through the form of dividends. I'm a dividend investor, so I just have money dropping into my account. I transfer it into my checking account, and then I buy groceries with it. So that's dividends. That's kind of the two ways that you can make money as an investor. I know everybody's going to be excited about this, but I want to talk to you about taxes. This is a combined federal and Alberta tax brackets and tax rates. The federal government charges us taxes to pay for the Army, Navy, etc. And each province also has taxes in order to pay for the roads and schooling, whatever. Tax brackets are shown in the leftmost column. And if you're working somewhere and you're getting paid a salary or wages, you are being taxed in the other income column. So if you make under 57,375 in Alberta, you're going to be taxed at 22.5%. So if you make 10,000 in 1 year, you're taking home 7,000 and change. Then the government is getting 2,250 from you. If you make over 50,000 but less than 60, for that less than 3,000 of income, you're going to be charged 28.5%. The first 57,000 is still going to get charged 22% in taxes. Anything over that is 28. If you get over 60,000 up to 114, then that's charged at 30. Now, there's two things I want you to see from this table. Okay, number one, people. I went to a seminar that was for retired people, and there were still questions where people didn't understand that if you make $1 more to get you into the next tax bracket, you pay the higher tax rate only on that $1 more, not on all of your income. So if you're making, let's eyeball it, if you're making 200,000 a year, your average tax rate is not 42, it's probably somewhere in the neighborhood of 30. Okay, just kind of eyeballing it. So you sort of go up through the tax brackets, but what people don't get is that as you go into a higher tax bracket, you're paying higher taxes only on that additional income, not on all of it. Okay. Now, let me introduce you to the other columns. Capital gains, I mentioned, if something goes up in value, only half of that is taxed. So capital gains are always taxed at a half the rate as regular income. Okay. And then for dividends, if they're Canadian dividends and they're for publicly traded company, you'll notice that the first 57,000 actually has a negative tax rate. So you don't actually pay any taxes on that. This is why I invest in Canadian companies, because their dividends are very tax efficient. Okay. And if you have an American company that pays you dividends, it goes back to here, to other income being taxed harshly. So what I want to show you here is, from a tax point of view, working for your money sucks. You want to be an investor. So I hope you guys can get there at some point. So first column is tax bracket. Second column is salary or wages. Third column is if you have an increase in share price, or if you have like an investment property, a house, you bought it for 400,000, you sell it for 500,000, you have $100,000 capital gain. Columns 4 and 5 are Canadian dividends. Progressive tax system I mentioned. People for a living are taxed heaviest. Investors are taxed more politely. At no tax bracket do you get charged as much in taxes as for somebody who has a salary. So it's just set up that way. Taxes are going to be your single biggest expense, no matter who you are. I'm not going to take you back to my budget, but my taxes were the biggest single expense. Not groceries, not mortgage. Generally, it's the taxes. The other suggestion I would have to you is if you have an income, file your taxes. If you have a low income, you can generally do them for free. That way you learn about them, or if you get them done along with your parents. The other thing is if you have income, you start accumulating something called RRSP room, Registered Retirement Savings Plan. It's good to have that started. Generally, there's a $16,000 exemption. So if you make under $16,000, you don't even get charged the 22.5%. Under $16,000, you're generally completely free for taxes. I wanted to show you something that a lot of people invest in, something called an exchange traded fund. I'm not going to dig too much into it. I just want to show you one. So we'll call them ETFs, exchange traded funds. They offer diversification, meaning when you buy an exchange traded fund, it has money in a whole bunch of different companies and geographies, depending on which one you buy. That way, if one company does badly, you don't even notice it. But if you buy an individual stock, like I mentioned, Google, Amazon, Netflix, Enbridge for Canadian, if that company does badly, you will notice that in their share price. The point of the ETFs is that you don't hit a home run, but you're also not going to strike out. So here's one. It's a favorite for the people in the financial independence community. This one's called Vanguard. Vanguard is the company that created this ETF. All equity, meaning it's all stocks. It's all company shares. ETF and portfolio, and I don't know if you can see it, there's a tiny VEQT. It's trading on the Toronto Stock Exchange, so this is in Canadian dollars. The highlights of this is it has a relatively low fee, 0.22% per year. So Vanguard wants to make money as well. So they basically take 1/5% each year. You can see how it's done. This is for the last year. I don't know if any of you followed the whole tariff thing, but we had a drop there. So that's what did that. Over 5 years, though, the average is 13% and change per year. So it's even higher than the 10% that I've been using in my examples. And down here, you can see the countries. So Canada is 30%, US is 43%. And then there's some in Japan, some in England, some in China, some Switzerland. And there's a whole bunch of other countries underneath that, but they're tiny weightings. So this covers the whole world. Arguably, this would have to be the only thing that you would need to buy. If I show it over a 5-year period, right, starting in 2020, you can see it trends upwards. You can see the dip that looks very nasty here is only a tiny dip when you look at it over a longer period of time. So this would be a possibility. I'm not saying this is right for you, but ETFs are what a lot of people investing choose to use. Low fee, diversified, meaning a lot of different companies, a lot of different countries with good performance. Volatility means the ups and downs. You do notice that you can lose money. The thing is, you just keep putting in your $40 a month, and eventually it recovers and it keeps going higher. And that's how you make money. To conclude, I would suggest learn on your own, educate yourself about money investing. I'm going to repeat again, nobody's ever going to take care of your money as well as you. People, and I find this puzzling, people will work for hours and hours, years and years for their money, and they don't want to spend a few hours to learn how to make their money work for them. I find that really puzzling. I know people, friends of mine, who spend hours and hours researching the next big TV they were going to buy or the next truck that they were going to buy. but the investing just isn't something they want to put time into. And it's relatively simple. The other thing is get a job that you enjoy, sell your time for money for a while, spend less than you earn, invest, and then achieve financial independence or whatever goals you have in life. And finally, getting to your financial goals is really simple, just those 4 things, but it's not always easy. You know, it's like, I want a new car, I want a boat. Don't buy a boat. Boats are terrible for money. Know somebody who owns a boat. don't own a boat. This concludes what I think is the most important financial information young people need to learn. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.